Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for the midday update from the mid, we have Brian Joyce. He's a Managing Director on Nasdaq's Market Intelligence Desk. And Brian, we have a lot to get through.
Yes.
What a difference a tweet makes. We kind of had the markets, humming along and I think surprising to the upside following the 25 basis point cut today. And then just before we were about to go on, tweet changed the narrative for today.
Yeah, if anything surprised me this morning was the strength we saw early on in today's session, particularly given yesterday what happened with the FOMC. But then, sure enough, Donald Trump comes out with a couple of tweets, and here we are back to new lows.
It seems as if the market didn't even move that much, like we're seeing the movement right now. I mean, significantly in the red. When the tweets first started coming out, I just don't think anyone had picked up on it yet because the market didn't drop precipitously like it normally does. My first thought was, okay, we kind of see these tweets day in and day out, and then it just seems like everyone kind of figured it out around 2 o'clock. And then we saw that move.
Same thing with me. I kind of had my head down working on other things, and I had my IM getting popped up. A couple of people saying, look what's going on in the marketplace. And sure enough, it took a little while, but sure enough, the market started to roll over pretty hard.
All right.
Just last Friday, we were making all-time highs. So.
Right, and if you think about it, despite the move that we're seeing now, we're only, what, 0.1% off of the all-time high. So you have to put things into perspective.
Yep.
Let's run through what we originally had planned to run through because we've been doing a lot of chart work on the XOP. We'll pull up our first chart. This is the daily. And the chart's saying a little bit of a different story than what sentiment might suggest.
Absolutely. So the XOP, it's the Exploration and Production ETF. It's part of the energy sector. Energy has a very low weight in the S&P 500. The sentiment for the overall space is pretty bearish right now. And it came up on my radar because a couple of days ago we were looking or waiting for the Fed. Markets had been in somewhat of a holding pattern. And I happened to notice on Tuesday this ETF was up 5%, which is a really strong percentage move for any ETF that's not a levered ETF. And sure enough, I could see that the prior day on Monday, it broke down to a new 52-week low below the prior lows made in December. And so Tuesday's relief rally, the dead cat bounce, whatever you want to call it, that's the level where you would expect short sellers to come in and cover those positions, or new entries, say short-term day traders or swing traders, look for an attractive entry point to buy that on the move back above the prior low made in December. And so that could certainly justify it. But when I took a longer-term perspective as to what this potential level meant, I was really surprised to see that this coincided. I don't know if we want to pull up the
actually,
monthly
let's
chart.
pull up the monthly on the XOP, and we can see the difference with the longer-term trends.
Yeah, and so it's pretty interesting and somewhat puzzling to me. So the lows we're currently making right now, we made these lows in December of 18. They're very much within the lows of the prior cyclical low of Q1 16 and even 2009. So what's different this time is right now the S&P, well, at least last Friday, the S&P was up 20%. Crude oil is down maybe about 20% from the recent highs made in April. I think it's about 18%, which may sound like a lot. But relative to these other time periods, in 2009, crude oil was down 78%. In 2016, crude oil was down 75%. The S&P was down a pretty significant amount both periods as well. I'm talking 58% for the S&P, 15% in 2016 for the S&P, and more recently in December, crude oil was down, I have it here, 46% from its recent high, and the S&P was down 20%. So here we have a little bit of a difference where the S&P is actually up 20%, but the XOP is making new lows here. So my takeaway is that if you're a longer-term investor looking to maybe jump in, sentiment again is overly bearish. You see very few people looking at this space, at least from what I can see. It could be an interesting level to start building a longer-term position here. If you're a shorter-term trader, be careful. This is not the chart you want to be looking at. But for longer-term investors with a long-term time horizon, this could be an entry level that's attractive.
Do you think the divergence from the S&P and the XOP, or within the exploration space, could be that energy doesn't make up as much of the S&P 500 anymore? For example, the S&P is more predisposed to what happens in larger tech names, communication services, and so forth.
Yeah, absolutely. And maybe also what it could be is that oil is, and the XOP is more reflected as to what's going on globally. And the economy globally is not doing nearly as well here in the U.S. In the U.S., the consumer is very strong. We saw that in the Q1 earnings reports from the big money center banks that have big credit card operations. You're just hearing that theme. The U.S. consumer is strong, at least for the time being right now. But we do know that manufacturing is not doing well in a lot of parts of the world, and here we're close to it in the U.S. There's a manufacturing recession, so to speak.
All right, let's move on to the S&P 500, and we're going to take a look at S&P 500 breadth. And this is something that you had pointed out back in June, where you were noticing a bullish breakout
Yeah, so the bottom panel here, the blue horizontal histogram, vertical histogram, what we have highlighted there is the breakout in breadth. So for the first time in early June, the first time since Q1, maybe in January of 18, about more than 13% of the S&P 500, the members within the S&P 500, have finally broken out to new 52-week highs. And the S&P at that point was still about 6% below its prior highs. So we felt that was a bullish leading indicator where more and more stocks are finally making new highs. And sure enough, the S&P in the following 7 weeks did eventually make new all-time highs and gained about another 5% to last Friday's high. But the concern then, last Friday, which we could see this week on Monday and Tuesday, is that only about 8% of the index is now making new all-time highs as of last Friday. And so fewer and fewer stocks are driving these new gains. It's not a long-term bearish signal, but it just says in the short term that the new highs is on weaker foundation, weaker breadth.
All right, let's move along to the S&P 500 on a 30-minute chart, and we're taking a look at basically charting Powell's comments from yesterday. We saw when it came out at 2 o'clock that we're getting a 25 basis point rate move lower. It didn't do too much. It was kind of flat. And then all of a sudden the comments came out at 2:30. Clearly the market not digesting that well.
Right, and that was very similar to what happened throughout Q4 when the market was moving lower. We still had numerous communications from Chairman Powell that were not received well, and yesterday was reminiscent of that. Prior to yesterday, throughout much of 2019, the Fed seemed to be getting it correct, where they were dovish or overly dovish, and the markets responded well to that. Yesterday, when they released their statement, we did see a minor pickup in volatility, a highlight there in the triangle pattern up there, and within 5 minutes of Fed Chairman Powell speaking, you could then see the sharp breakdown lower. And so, yeah, the Fed did deliver on their 25 basis rate cut, which is what the market was looking for, but the commentary was confusing, much like Q4, and investors, were certainly
Let's look at our last S&P 500 chart. Now, this is on the monthly, a little bit longer term. I was kind of surprised that we did not get follow through on the sell-off action that we saw yesterday, and that we were significantly triple digits higher in the Dow. And of course, we have our about 25.25% lower than when we first started. So we're seeing the market continue to react to those tariff tweets. But longer term, this looks kind of bullish to me.
Yeah, so short term, we just highlighted a couple of reasons to be cautious on the S&P 500. So we could potentially see a pullback. Another thing I did forget to mention is that seasonality for the S&P 500 is very weak in the month of August. So August over the last 10 years has been the worst performing month. And if you go back to 1950, that's a long time, it's about 70 years. It's the second worst performing month, second only to September, which we have just 1 month ahead to look forward to. But longer term, if we do get that dip, that pullback this month and next, this indicator at the moment is beginning to cross. So the MACD on a monthly period really takes a while to move around. It's like a big ship in the sea. And we are seeing now, what we did see in the month of July, a bullish crossover in the S&P 500, which we can see the prior two occasions in early 16, or I should say in late 16 and in early 2012, bullish crossovers then, which in those two instances, it's a small sample, but it was a very good indicator.
All right, let's wrap it up with our last chart, and we're taking a look at the US dollar index here, and there's a couple things that you wanted to point out. Part of this could be why we saw the tweet this afternoon. Right,
so when we had the breakdown yesterday in the S&P 500, we did see, conversely, a bullish move in the US dollar. The dollar index, the DXY, it broke out to fresh 2-year highs, and then today we saw upside follow through. So we knew at that point that Chairman Powell and the Fed had disappointed the markets. They were looking for a more dovish commentary, so stocks went lower, rates went lower, and the dollar went higher. And the dollar is essentially what President Trump seems to have a real problem with on the trade front, and he's trying to get that dollar to be weaker. So that move in the dollar, when I saw that, I knew, or I was expecting the Trump to come out yesterday with some negative commentary on what the Fed did, which in fact it did. But the other thing that it seems the president has learned over the last month or the last quarter or 2 quarters is that the harder he gets on China, the more the Fed appears to have to lean towards the dovish side of things. And sure enough, today, midday, we see a series of tweets from the Fed, or I should say from President Trump, criticizing China for not living up to the early terms of what they've agreed on, the preliminary terms about buying agriculture, about limiting drugs coming into the country. And so sure enough, he threatened to impose more tariffs on China. So
meanwhile, just yesterday, China and U.S. trade talks were going well.
Yeah.
So Yeah, it's interesting.
You have to stay on your toes.
Yeah, you certainly do. It's got to be tough if you're out there, especially if you're a long-only fund. So, all right, Brian, thank you so much as always for the chart talk. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.